All right, thank you everyone. Welcome to the second panel today, the battle for RWA protocol dominance. One of the most common questions we get from issuers is what technology should we use for our issuance? So to set the stage a little bit, a leading aggregator of RWA data says that there are currently 33 billion in RWAs issued in the market today. The leading protocols are Ethereum with $11 billion, ZK Sync Era, Polygon kind of in the middle, and then Avalanche at the bottom with 1.1 billion. Is this an accurate representation of the state of the market? Samson.
Well, I don't think that's accurate because Liquid has almost 4 billion, more than 4 billion of tokenized assets on with stable coins, promissory notes, and just security tokens. So I think it's just behind Ethereum in terms of raw volume of RWA.
Adolfo, should stablecoins count and be included in RWA?
We don't count them, at least when we make our own calculations. But to your previous question, I wanted to say that, yeah, I mean, basically one of the main features of a blockchain capital markets and one that everyone requests is confidentiality. And of course, if it's confidential, you know, people that are parsing information from assets from blockchains, public blockchains, are never going to get it from a confidential blockchain. There is one more aimed at institutional capital markets that has quite a lot of traction as well, and it's not counted there. But I mean, there are many reasons why I am a skeptic about those figures. You know, mainly one of them is perhaps the fact that many of these other blockchains have as their core business, you know, marketing, right? So we need to be aware of that. But also the fact that many of the use cases are, you know, that are depicted in RWA, for example, are rather simple, right? And so it's not, I wouldn't call them, many of them actual traction. You know, what I would like to call traction is use cases where you are actually solving a problem, when an asset is actually trading, when there is a payout, you know, or a payback in a loan, a dividend, et cetera, you know, and I don't think that's the case in RWA.
So maybe to provide a little bit of additional context on where people are coming from, I used to work at Blockstream, Samson used to work at Blockstream, and Adolfo currently works at Blockstream. Victor, as someone who maybe has a less biased opinion, what are your thoughts on the state of the market? Do you think the numbers that I just presented are accurate?
I think to a certain extent they are, but I would add some other stuff in the mix. I would say that also there are a lot of private chains, private networks that are run by banks, for example, or by other institutions. Like the Swiss Stock Exchange has its own private network, and in that network they have hundreds of millions or a few billions of bonds and other tokenized assets. There's not a lot of liquidity, but they're tokenized. There are some other initiatives now that are trying to tokenize on other private networks or privacy-focused networks like Canton. They have a lot of volumes going on there, but they don't give access to retail. So I think that your numbers are accurate, but there are other players left outside. These players that are left outside of the conversation might not be important in the future, because I think the future of tokenization is going to be on public networks. I think it's going to be on, or maybe on a liquid network. Some people might prefer Ethereum or Solana for their easiness of launching a token. Maybe some people will prefer other chains, but yeah.
Yeah, so that's interesting and ties into our previous conversation. So if some of these big private bank issuances, which I think are at about $10 billion in aggregate, if they don't allow retail access, if they don't integrate with Bitcoin and USDT, is this really tokenization? Samson, what is a token?
Well, that's kind of a loaded question, right? I think a token is just almost like a bearer share. And what we're seeing now is that the traditional equity markets are trying to get to become more like a crypto asset. So they're opening up to almost 24/7 trading now. And that's kind of infringing upon one of the proposed benefits of tokenization, that it is a seamless market, that you're trading constantly. And I think the challenge now for tokenized assets is trying to get to a bearer state, which is kind of like Bitcoin. So Bitcoin got us back to a bearer asset, like a bearer gold asset. And then I think stablecoins are quite close to like a bearer cash, like a bearer fiat, physical paper money. And I think the potential for security tokens is to get to that bearer state, but it is a token at the end of the day, and ideally you can trade it and do what you want with it. But because of regulatory issues, I don't think we're quite there yet. And a lot of the tokenized assets are tokenized in name only. I think there are some pilot programs in Singapore and Korea where they're pitching them as STOs, but they're largely in a closed ecosystem and fully controlled and very permissioned. So at all levels. So it's not really what I would say is a tokenized asset. I think with Liquid, you get far closer to that with like what was it called again? The
Transfer restrictions?
yeah, transfer restrictions. So once you're whitelisted on the transfer list, then you can trade it freely with anyone you want within that pool. So I think that's the closest you can get in the best format possible with the best cost possible.
Adolfo, what do you think are the key characteristics of tokenization?
For me, I read a book by Hernando de Soto, The Mystery of Capital, and this book was talking about the property systems in emerging countries. I'm very aligned with Paolo's talk earlier when he said what problems it solves. And basically this book explained how hard it is in many countries that do not share, let's say, Western culture to put together these property systems, to make sure that when someone is meant to own something, all the rights embedded within that ownership are actually possible to enforce, right? And this happens with land registry and a number of things, but also with financial markets. And so I think that for me, tokenization is the digital representation of an asset in which the ownership is not, it's very hard to argue about, right? Because you either own the keys or don't. You don't need, you can avoid the need for many of the traditional institutions that are in the middle in the US or Europe to make sure that something is owned by somebody, right? And you can minimize the disputes that are the consequence of that ownership. So yeah, it's to the point of some, it's basically, of Samsung is basically the idea of a better asset. You cannot, once it's yours, there is no way someone can argue, no, it's not, unless there has been a mistake with an address or something very weird. But yeah, that is for me what makes it most interesting.
Victor, in your role as a certifier, maybe you can clarify to the audience what the certifier is, because it's kind of a unique role within the El Salvador regulatory framework. So maybe if you can clarify what that role is, and then the different issuers that you speak to, what are their preferences in terms of issuance technology, and what are the features they're looking for as well?
Sure. So in El Salvador, we have this entity which is called a certifier. The certifier is basically like an auditor that before you do an issuance and before the issuance papers will reach the regulator, the certifier needs to verify and give its okay. So it's like an authorized auditor, if you might say it. From what we've seen in El Salvador, there are multiple types of companies. The local ones prefer to launch their tokens using the Ethereum TRX standard. The regulator likes it because it's you have a lot of tools to lock, freeze, to keep a good grasp and control over the tokens. A lot of the people that are doing more international business and they're partnering with Bitfinex Securities or other big players there, they like to issue on the Liquid network. Some other players try to play with different token standards. I think at the moment Bitcoin Liquid is the most used one there. So yeah, and in general, just to give you some general advice, if you ever want to launch a token in El Salvador, it's quite easy. You have two types of issuances, private or public. If you want to go on the public route, you can list on Bitfinex or on the other digital asset service providers in the country. Most of them, or some of them, are connected already to the Liquid network, yeah.
So Victor mentioned this concept of the restrictions that a regulator might need to have on the tokens. I think that's kind of a reflection of the fact that the securities business is to some degree centralized, and I think it's difficult to get away from. We talked about this idea of bearer assets. You know, securities are not bearer assets, and I don't think they really can be anymore. It's very difficult to get there, I think, and to get regulatory approval. So Adolfo, and I think that's a key part of how the Liquid network has kind of done a trade-off in terms of that reality, and then also with giving people a kind of a Bitcoin or Tether-like user experience. Adolfo, what do you think are the features that are important from the Liquid network that make it a good asset a good protocol to issue on top of?
Yeah, in my experience, well, there are quite a few. I mean, I hope I remember many, but for example, in talks, Adam mentioned it earlier, in some of our talks, we noticed that investors do not feel comfortable having to, hold a security, a native token that could be deemed an unregistered security, because in case of disputes that could become a problem. But then the fact that it's confidential avoids the problem of MEV. The way UTXO works avoids the problem of reentrancy. The fact it's confidential avoids front running. Our smart contracts are formally verifiable with simplicity, so you can be sure of the output of a computation in advance, which is exactly what you want when you're dealing with billions, right? And for example, in one of our conversations, well, I cannot share many details, but with a company that managed to build a use case that is getting a lot of traction in the US, I mean, they want to be sure of what happens, right? And these are the use cases where avoiding the need to put extra collateral makes them save a lot of money, right? And they want to make sure that they are not making mistakes. Something that I think many people, in my experience in TradFi, do not realize is that while they're looking at the security of custody, right? What happens since you create the keys and afterwards, they haven't been focusing on what happens at the protocol level, and they frequently even say tech is a commodity, But if you look back, most of the hacks have happened at the protocol level, right? The Bybit, Parity, DAO, all these things. And so I think all these features are important if you really want to enforce those rights with software and cryptography, which is what we're doing, after all, with Bitcoin technology, right? And so if you want to minimize the need for those institutions that are presently in the West, but not that present in emerging countries, you need to have hardcore security, right? That is the way I see it, and that's our approach.
So as you kind of touched on, smart contracts have a bit of a checkered past. Like a lot of the big breaches of the last couple of years have been from at the protocol level. The Liquid network approach is, slightly more centralized with the server-based approach. So how do you, Samson, what are the trade-offs that you kind of need to consider, and what does history kind of teach us about what has happened in the past?
Well, I think the server-based approach is more pragmatic overall. But just to add to Adolfo's points on why Liquid, the other factor is cost. So Liquid being a sidechain, it has its own fee market, and the fees are mostly an anti-DDoS mechanism. Whereas if you're issuing on like an ICO project like Ethereum or Solana or anything like that, their motivation is to pump the price of the token, which increases the cost of every transaction, which increases the cost of things like whitelisting. I think early on when Stoker was looking at options, they originally built on Ethereum, and then they found, because the fees were so high, they were paying $100 to whitelist a new person onto the registry. And at scale, that doesn't really make any sense. And it doesn't make any economic sense either if you're raising capital as a project. So I think Liquid solves that by being, one, using the server for whitelisting and permission. But the network itself is disconnected, or, I don't know, de-risked by not having that same connection to the asset that is being used to pay for the gas or transport fees too. So what was your original question?
Well, I think exactly that, the trade-off between smart contracts and kind of the more centralized, slightly centralized server approach.
I can add something to that, because what I learned is that when you talk to banks, basically Liquid Network is just, the main existing one is one implementation, but we are working on others, right? And because some banks want to have their entire control of what's in there, and perhaps they like the tech, but they do not exactly like, or don't know the existing members. But what I've learned is that when I go to them and I talk to them, hey, can we build something together? They're like, we would never build on a blockchain that is managed by a foundation which has a very clear roadmap, because that is a counterparty risk we cannot afford. Instead, if we can start a network with a number of banks we've been dealing with for decades, right, and where we keep entire control on the governance level, that is something we could be very comfortable with, right? And so the trust model is simply, if you think about it, the federation is actually the most proven consensus model in finance, if you think about it, because central banks, depositories, clearinghouses, even national stock exchanges are actually federations of members. So they take decisions in a very similar way. So by adding all the tech on top of it, I think we have a model that really caters to something they are very used to.
From my experience, just to add on what Adolfo was saying, from my previous life when I was talking to a lot of banks, everybody wants to be secure, everybody wants to have control over everything, but at the same time they also want liquidity. So you can't get both of them. So back in the days, 2017, 18, they were trying to build their own networks, they were trying to run their own private Ethereum networks, they were trying different experiments. Most of them failed because they didn't have a good community to develop further the tech. Bitcoin has it. They didn't have the community to trade and to build. For example, Ethereum also has it. They don't have the enthusiasm like you see in an ecosystem like Solana, which is full of meme coins. But the meme coin ecosystem helped them create the rails for the future. Maybe they will do tokenized equity on them. And what I realized is that regulators also want to have this control. I think in the future things are going to be a bit more relaxed. They will realize that they cannot get anywhere if they're going to have their own small networks, that it's connected only to 3-4 players, they don't have exposure, they don't have access to liquidity. So I think the future is going to be for public networks where security tokens are going to land.
Yeah, I think Adam touched on that in the previous panel. I think everybody wants to create a syndicate is the natural reaction, but then nobody wants to join your syndicate.
I think if you have like 3-4 big players that will play amongst each other, okay, they want to have privacy. They don't want to see. They don't want the world to see how much they're trading, in which way. But if you want to tokenize the shares of your company, okay, in some legislations you can't have bearer shares anymore because of multiple reasons. That's why they want people in their ecosystem to use special smart contracts or special standards for their tokens. But yeah, you need access to the whole market. You need access to the liquidity. That's beneficial for everybody.
Victor touched on an interesting point, which is privacy seems to be a new concern. People seem to care suddenly. I think, who was it, Niraj posted a couple days ago, like, what about privacy and stablecoins? And a bunch of stablecoin issuers said, yeah, we're building it, it's coming. I think Coinbase has said something along those lines too, like they're trying to add privacy to their chain. Yeah. But privacy something was built into Liquid from day one with confidential transactions. And I think the world is kind of catching up to what Blockstream and Liquid has out there for 8 years now. Yeah. And it's kind of a no-brainer when you really think about it. Even when you are just thinking purely on the stablecoin use case, if you're transacting stablecoins and it's all open, and let's say you're in a country that's less lawful, someone can see how much you have and go and rob you. And I think that principle largely applies to tokenized securities too. Do you really want miner extracted value when you're trading or moving security tokens around? And this sort of de-risks it, adding that privacy dimension to STOs and RWAs.
Yeah, I think that's worth explaining. So confidential transactions, Adolfo, could you explain what confidential transactions are so that people can maybe focus on that a little bit?
Yeah, confidential transaction, it means basically that the sender and the receiver can selectively share the content of a transaction with anybody of their choice. But they are confidential. Nobody else can see it if they don't give their permission. But then there are ways that the issuer can show information to a regulator of the entire unblinded a list of transactions if it were required, right? And so, yeah, this is a feature that I'm tired to go to TradFi events and then they start saying exactly like Samson, hey, I think we are getting very close from privacy. You know, I feel like while I'm sitting in there, you know, like standing up and raising my hand, like, excuse me, we've had it for so long and flawlessly, you know, without any issue. When you're working with cryptography, what you want is not the new fancy technology, but things that have really passed the test of time. And we have proven with CK range proofs that this is perfectly possible from day one and without any issues, right? But the fact is that most of the financial markets are not even aware of the crucial differences between an account-based model chain and a UTXO-based model chain. The latter, confidentiality is way easier, right? Because of this tendency to disaggregate information. While in account-based models, they've been trying for a decade and they're not getting there, right? And in fact, the only, as Victor was saying, the only chain out there that has confidentiality other than Liquid is Canton, and it happens to be UTXO as well, right? So, yeah, I mean, it's something that I wish we were able to put this message across better. I mean, we're working on it, but we'll get there.
Yeah, and in practice, what that looks like is that when you make a transaction, anyone using a blockchain explorer, you may see on Twitter sometimes someone says, oh, 100,000 Bitcoin moved to this or that, you know, and everyone pays attention to it. The idea is not to flag the market when you're doing these transactions, you know, through these blockchain explorers. So when you do a transaction with Liquid, you can't see the size or type, just that there's been a transaction that has gone through. So you don't know if it's a USDT transaction or if it's a, you know, a tokenized security transaction.
Right.
And of course, for investors like big TradFi kind of guys, they don't really want to flag the market that they've just sent a bunch of security tokens to an exchange where they're presumably going to dump it on you.
And that is also comes back to your initial question. When you see all these issuances, you realize that everything that has been going on in most of these chains, by definition, cannot be really sophisticated unless they had confidentiality, because nobody is going to dare really to make important trades that anybody can see and front run, right? So, yeah, this is a very crucial point indeed.
So you made kind of an interesting observation, Adolfo, and I've noticed this. I do the Blockstream, the Bitcoin Capital podcast, which is kind of Bitfinex Securities and Blockstream, and we've talked to a lot of high-profile people, and I've noticed, especially in the U.S., Scaramucci was a really good example. He loves Bitcoin as an investment, but he also likes Solana and Ethereum because he's very bullish on security tokenization. So he doesn't even know that you can do security tokenization on a Bitcoin layer 2. So how did we get here? How come the message hasn't been received by some of these very big influential Bitcoin people? And how do we bridge that gap?
Well, I mean, yeah, and getting back again, I think most blockchains out there, we have to admit it, their core business is marketing. You know, they do it way better than we do. And they have massive budgets. When I go to these TradFi events, you know, they buy all these massive booths and side events, and there is no even mind share of Bitcoin capital markets existing. We're working hard, and there are going to be many things going on in the near term to make it happen, but it hasn't happened in the past, right? And so the mind share about the ability to build not only capital markets but better ones out there is almost non-existent. And by the way, yes, I think that it also needs, people need to understand the trade-off of blockchains and why it is critical that we preserve the trust minimization of Bitcoin mainnet, right? And why it is important to build these kind of things on layer 2s, you know, if you really want to not compromise that security. Because if you compromise that security and trust minimization of the mainnet, what you're doing essentially is, since, in my opinion, it doesn't make sense to hold the second most trust minimized asset, right? Because it's like, I don't know, it's like, you know, choosing the second best air raid shelter during a bombing, right? That doesn't make much sense. You want the best one at all times. And so if that's the case, the value of all those other tokens, which is what finances those infrastructures.
Are you trying to say there is no second best?
Kind of, yeah. He says it way better than I do, though. But yeah, I mean, that's the case. And I think these kind of messages, I think we have a very good story, and we need to work harder to make it publicly available.
I agree with Adolfo. I think a lot of these other chains, they launched their ICO and they have a ton of capital to build out the market and user base. Whereas Liquid was something that was launched organically, just between, originally maybe 15 federation members, and now we're at 60 some odd members, and it's all organic. There is no pool of marketing capital. There was no ICO. There's no, Jesse has no big boat to take us all out on yet. But it shows that there's real demand and real use. So I think it's pretty impressive that we've managed to get to where we are today, and the fact that in El Salvador most of the issuers are using Liquid is a testament to that as well.
Let me add something here, because I think it's important to to make this more transparent. When I meet people in these banks, there are so many people in making decisions with regards to blockchain departments that belong to the Ethereum Foundation, which means they've been delivered tokens. So imagine the conflicting interests of these people to push any other technology. That is almost non-existent, right? But then when you manage to get to the right people in a bank, the decision maker, CTO or something that is not related to the foundation of Ethereum, then you pitch it, right? And they understand the technicalities, why the UTXO model is better. But then all of a sudden, when you ask them, hey, okay, you liked it very much, but why are not you changing? And they openly tell you, when they leave the bank, by the way, after that, they openly tell you that the reason is basically that nobody dares to tell their board, hey, we dumped like $100 million over the last 10 years in this, and we don't want to change to another technology, right? So it's more like there are many interests and conflicting interests that I think that in the short run are preventing Bitcoin capital markets to becoming more widely known out there.
What I think is going to help, it's going to help when all the banks will have their own custody systems, when they're going to have their own fire blocks, when they're going to have their own coppers and whatever, and when these systems will give them easy access to the Liquid network. So if I have a bank, if I'm a bank, I'm the operations guy, my boss tells me we need to issue 1,000 tokens, and I can choose from a menu, issue on the Liquid network, issue on that network, issue on that network, and I just type in some numbers and just launch. I think when that moment is going to happen, and the Liquid network is going to push a bit, and there is going to do a bit of marketing, it's going to be a no-brainer. And then maybe if I put my consultant hat on, when you're going to have a leaderboard with the most traded assets, if it's possible, on the Liquid network, or what's out, what was launched recently on the Liquid network. People like leaderboards. You go on CoinMarketCap, oh, my coin is number 76 out of 100. It doesn't matter if it's not going to be there in 2 years. People care about now. Oh, I saw that you're in top 10 coins now. When there's going to be something like this on the Liquid network where people can have some metrics, that's going to push it even more.
I also wanted to say that I don't have a boat, but I did lose my Bitcoin in a boating accident. So
we all did.
And did the tax authorities believe you?
Adolfo, I wanted you to give us a little bit more clarity on those numbers, because I meant to ask this at the beginning of the conversation when we were talking about the rankings, because I think one of the interesting things about Liquid is that there's probably, I think you said 4 million or so?
4 billion.
4 billion, sorry, 4 billion worth of assets issued on Liquid, and almost all of that is security tokens. We have about 250 million worth of assets on our platform, all on Liquid. Stalker has done several hundred million. I know that in Mexico, what those guys are doing with the promissory notes, they probably, I mean, last time I checked, they were well over $1 billion, so they might have 2 billion now.
2 billion already, yeah.
Can you add a little bit of color about some of these bigger issuances and what the security token ratio is to total assets issued?
Yeah, I mean, RWA is currently around 90% of the 4 billion. The asset I'm definitely most...
You said 90%.
90, yes. The asset I'm definitely most interested on, because it's really solving a huge problem, and it's related to what I explained. I think it's the tokenization value, is these promissory notes from Mexico. Because while you can, as I think it was Paolo saying, you can tokenize interesting equity and then distributing it to developing countries, you can also do the reverse. You can unlock interesting capital and assets coming from emerging countries and putting them available to investors worldwide. And that is the part I'm most interested in, because the cost of capital for these countries is huge. And they frequently, and that is the reason why, for example, Kazakhstan and El Salvador have a huge opportunity, in my view, because if you just do it right in terms of the law that protects the rights of the investor at first, then all the property system will be done with our tech, you know? And so in regards to these promissory notes, I was not aware, but the legal security of the asset itself is very strong. You know, it's very strong. The only part you miss is this property system that can enable the parties that issue these assets to trade it with each other in secure conditions, right? And so nobody was able before to access them and to actually have guarantees that they actually own them. Now they do, you know, and so we are basically unlocking promissory notes that are backing loans coming from Mexico, and the potential is huge. You know, it's private credit in general, for me, is one of the most interesting use cases indeed.
All right, 2 more questions, and then we're going to open up to the audience. Samson, the Aqua wallet is my favorite wallet, and not just because you gave me T-shirts, because it's very easy to use. Is there a path? Do you have a plan to put RWAs and STOs on the Aqua wallet?
Yeah, definitely. I mean, one of the things that I wanted to do with Aqua was have Bitcoin bonds there, so that you could invest, buy the Bitcoin bonds, and also receive your coupon payments and dividends in a simple, easy-to-use wallet. But I think we'll get there. It just takes some time. We have a long roadmap of things that we need to add before that, but that gives you time to get more assets and more Bitcoin bonds issued. So I think it will be there. But the other thing is, you said it will be difficult to get back to bearer assets. I think it's not that hard, because demand for capital will push the regulators to move in that direction to better access more capital. And I think what Paulo was saying earlier at the end of the Q&A session from the previous panel was, you'll see, it's not like, what was it, making it easier for people to get onto Bitfinex Securities. That's not something that you guys can do yourselves. It's also partly the regulators too. Yeah. But the direction we're seeing, especially with the atmosphere and disposition in the US to digital assets, is very encouraging. So I think what we will see is some loosening, some encouragement for bearer assets, and I think once that comes, it'll be difficult to go back to having these transfer restrictions, and that will unlock a lot of capital around the world.
I agree. I think that's a huge opportunity, and also for things like accredited investor restrictions and not letting young people who have really been disenfranchised and been unable to invest in a lot of different asset classes.
Right, but if you look at like, what are people investing in now? They're investing in meme coins, yeah. And there is no accredited meme coin investor certification that I know of. But that's the competition. Your traditional finance, your competition is meme coins. So how do you get that back? You have to go back to bearer standards eventually, or else you can't compete.
If I may, here I don't think they're competing with meme coins. I think meme coins are just training the younger generation. They're teaching them how to trade. They're teaching them what are the risks of losing money.
Hold on, Victor. This is quite a unique position. I haven't heard this one before.
So I think people now are 20-year-olds are trading meme coins. They get into the game. In 5 years, they're going to trade shares. In 10 years, they're going to trade bonds. And they're going to use the same infrastructure that was built for meme coins. That's what I think is happening. First, they start chewing gum with coffee flavor, then they start drinking coffee because that brings them back to their childhood, maybe. So and bear.
The value proposition is as an educational tool.
Could be, if you don't lose all your parents' money. You could trade a bit of meme coins just to play a bit and to get a sense of how the capital markets are. They're always against you. You might lose everything. You might gain a lot. You might sell too early. You might sell too late. So
you might be exit liquidity.
Exactly. Yeah, most of the times.
But I think the thing is, people will trade whatever they can trade, and the barrier to trading crypto, meme coins, and all those things is almost zero. So the competition is fighting with something with zero barrier to entry. And you could also say stocks are meme coins for boomers too.
Yeah, I mean, we can put it like that. When it comes to bearer shares, I believe the biggest and the strongest and the most important digital bearer asset is Bitcoin, and there's no second best to that for sure. When it comes to shares in companies that are in the form of a digital bearer asset, I think you get a bit of complexity there when it comes to who controls actually the company, who gets to vote on decisions. In this case, bearer shares or tokenized shares are going to be a bit difficult to be accepted by regulators when it comes to tokenized gold, when it comes to tokenized debt, when it comes to tokenized assets that don't have a lot of corporate actions around them, and they don't come with a lot of control. I think that's going to be more easily accepted by regulators and the people in the market. Yeah.
Okay, to wrap it up very quickly so that we have time for the audience to ask a few questions, how do you see this playing out over the next 2 to 5 years? Do you think it's going to be winner take all? Will one protocol kind of dominate, and one protocol to rule them all? Or do you think it's going to be a multiple of different protocols that are competing, kind of somewhat similar that we have today?
I think that, I mean, there are going to be many chains still for a while, but I also think that, or my view is, and that's why I insisted on the security standpoint, is that at the end, what regulators want, what everyone wants is to enforce the rights of the investors over the assets, right? And if that's the case, you either have a really developed legal system, or you have tech that truly removes the need for it, right? And so that's why security for me is where the most secure blockchain is the one that is going to accrue value in the long run. But for that to happen, we need to move to use cases that are more sophisticated, where the security is actually needed. Because if what you're going to do is issue something, and this is a sentence from Jesse that I love, issuing with your right hand and buying it with your left one, I mean, there is not really a lot of need for security in that case, right? But if you're using a collateral as you're moving assets around, you're doing atomic swaps where you don't want to have fragile single points of failure in the middle with the smart contracts and so on, chances are you will prefer to issue stuff on a secure layer.
Samson, final thoughts? How do you think this plays out?
I think in the long run, Liquid or something like Liquid will win, because it's a question of proximity to Bitcoin. I think if you're issuing and trading a security token against a dollar currency or a stable coin, it matters less. You could do it on Solana, Ethereum, whatever. But if you want less counterparty risk, you want to get closer to Bitcoin and you want to trade against Bitcoin, then it's probably trading with block trades against Liquid Bitcoin, which you can then peg out. Because if you're trading against, if you want to trade against Bitcoin on Ethereum, you're using wrapped Ethereum, which adds additional layer of counterparty risk because someone is wrapping that. So not only do you have the counterparty risk with the issuer of the stock, but also the asset you're trading against. And I think eventually people will want to mitigate that risk and get closer and closer to the pristine asset that is Bitcoin.
Proximity to Bitcoin, I like that. Maybe 2 questions from the audience. Patricia?
Hi, yeah, my question is regarding the recent developments on the Bitcoin core devs with the CSAM thing. How would that affect all of these that we were talking about just now? If it really came to like deteriorate the security of Bitcoin?
Well, I think that's a hotly discussed topic, but personally I don't know if the risk is as bad as it's made out to be, because it's not native data. Like, you still have to decode data. But I can see the point that's being made that governments might say, okay, this is something illegal that's on your node. But I think it doesn't really impact the security token on real world assets, because like we're talking about issuing on Liquid, which is a side chain. But I can see like there is negative perception right now based on these heated discussions that are out there in the public discourse.
Yeah, I mean, whatever is perceived by the Federation of Liquid as a threat to the network will just be asked to Blockstream as the maintainer of the technology to be removed. So for us, it wouldn't be an issue. Basically, Liquid is a fork, right, of Bitcoin, and it shares I think it's 85% of the code base with Bitcoin. And so, yeah, if members of the federation were reluctant to add a feature that could compromise the security in any way, or security, or legal stance of the network, yeah, they would probably ask us, hey, remove that, and we will have to follow orders.
I was hoping that someone would ask that question to Adam about some of these recent controversies.
Hot topic.
Well, I didn't want to ask it. Maybe one more question and then we'll wrap it up.
Hello. Some issuers might want to do things like pay coupons, dividends, principals. Maybe there are mergers and acquisitions and things like that. Do you have any opinions on which protocol is better suited for handling corporate actions?
I think none of them are well suited at the moment, from my experience. I think that's going to be the next step in the future. Once there's going to be enough volumes, once there's going to be enough interest in the trading part, the next step would be corporate actions. And I don't think they're going to be done necessarily at a protocol level. I think they're going to be done by this custody technology providers like the Coppers, the Fireblocks. All these guys are going to have the extra features that their users will pay on top in order to split a stock or to do some dividend distribution. I think they're going to be the winners in the space, and they're going to build the tools when there's going to be enough demand for it. And through the demand, they would need to see actually money coming in to pay for the development. That's my opinion.
I'm going to say something that perhaps is very obvious, but liquid. Liquid, you know, we believe that pretending that, you know, to decentralize something that is centralized by default, like regulation, doesn't make sense. So that's why we run an asset management platform that manages all these kind of corporate actions. And I own a very small amount of equity in a company whose shares are issued on the Liquid network, and they do the general assemblies, the voting, and the paying dividends there. And Stoker has also managed the split of MicroStrategy shares, no problem. But also there are advantages, because if you think about it, when you look at the ERC 3643 smart standards, you know, they work by doing transactions that need to synchronize. So it's very difficult to get a snapshot of what, or let's say of a picture of who owns what at any particular point in time. You know, there might be discrepancies because you need transactions to be truly settled, right? While in Liquid, with AMP, we can simply get a snapshot immediately. And there's, you know, we can know right now who owns what, and there are not going to be discrepancies between the truth and who actually owns what. And so there are many advantages by not having to pretend you are decentralized. Regulation is centralized by default, so why overcomplicating it, right? Again, I'm not talking about theoretical things. These things that are happening right now on Liquid.
All right, I think that's a good place to wrap it up. Thank you, Samson, Adolfo, and Victor for joining the conversation. I think this is a very interesting one. We'll take a 10-minute break, and then we'll be back to talk about tokenized equity with Patrick Murphy from 8Cap, Gabor Gerbax from Hadron, Arnab Naskar from Stalker, and last but certainly not least, CEO of AFSA, our regulator in Astana, Kazakhstan, Evgenia. So 10 minutes, and we'll come back for the third panel. Thank you.
Thanks, Jesse.